Since the end of March this year, the Australian stock market has now risen more than 20%, and the US market has risen more than 30%. And during this same period, the economy has gotten worse. So the question is, why is the market doing so well when the economy is doing so badly? So today I'm going to talk to you about 3 reasons that's driving this. The first reason is that the stock market is forward-looking. We often think that the stock market and the economy are the same. While they're related, they're not the same. The economy tells us what's already happened, things like the unemployment rate, inflation, economic output, etc. It's looking backward. The stock market, on the other hand, is looking forward. Future prospects of the economy have already been embedded in the prices today through the selling and the buying of shares among investors. For example, the market already expected very bad unemployment figures in this pandemic. So when the news came out, it actually didn't move the market much. Another example is the GFC. 2009 was the worst year in terms of economic downturn. But the market, being forward-looking, it saw that there was more pain to come. But at the same time, it also saw the light at the end of the tunnel. So by the end of 2009, even though the economy was still in a very bad shape, the stock market has actually returned 26% in the worst year of GFC. The second reason is that the stock market is driven by large companies. This crisis hit the hardest local small businesses, not the big ones. These small businesses didn't have the deep pocket and the resources, so they took a big hit. The thing is, these small businesses are not listed on the stock market. And you could argue some of the big companies that are listed on the stock market could stand to benefit from this situation. If my local coffee shop is not going to make it through, it's possible that might benefit a large coffee shop chain. The third reason is that the stock market rewards investors with long-term cash flows. When you buy shares, you buy ownership into a company. You are entitled to a share of the profits of the company as long as you own the company and the company exists, which is a very long time. Some companies have been paying investors for over 100 years. When you look at it that way, how much does 1 or 2 years matter if you get paid that long? So investors are not just looking at the year 2020, they're looking at 2021 and beyond. So here are the 3 factors contributing to the disconnect between the economy and the stock market we're seeing right now. It's because the share market is forward-looking while the economy is backward-looking. It's because the share market is driven by large companies, and when people invest in the share market, they are investing for long-term cash flows. I hope this helps. If you have any questions, please reach out to me.